Good afternoon and welcome to the FX Week Ahead live market analysis with myself, Giles Coughlin. Special welcome if you're joining us for the first time. Just saying hello to folks as they come in. Hi Van, good to have you back. Hi Sheik, good to have you around. We have got quite an interesting situation that's developed over the weekend, so we'll be covering that as we get going. I hope you guys are okay. Hello Clement, nice to have you on board. As other folks just coming into the webinar now, just going to run through the disclaimer. Remember, as always, the whole idea of this FX Week Ahead and the workshop is it's all about showing you guys, as it were, looking over a professional trader's shoulder so that you can see how I go about analysing the markets in order to make trading decisions. And the whole thinking is that as you see my thinking process, that you start to see what a professional trader looks for, and then you can start to see what you should be looking for to help you make your own independent trading decisions. So that's the thinking behind it. What this isn't, it isn't a signal service where I'm recommending different currencies or commodities to buy or sell. That's not the point. So even though we are looking at potential entries and exits and take profits, it's not so you guys just go and copy it. Instead, you're seeing, oh, these are areas where I'm expecting buyers or sellers or stops or take profits to happen. So it's an education perspective rather than, an invitation for you guys to trade. Just want to make that clear. Hi, Carrick. Nice to have you here. I'm glad you could make it. That's great. Ifam, Eugenia, Van again. Yeah, that's great. Okay, guys, we've got a few of us here, so we'll start getting going, and the rest can join as they come in, or they'll catch the recording. So the first thing for us to look at as we start this week is we saw that equity markets were broadly down on risk aversion. And the big news, obviously, was the Saudi oil field attacks over the weekend. That was, well reported across all mainstream media. And, I think 5% of the world's petroleum comes from these particular oil fields. So this was a huge news for the oil markets in particular. And we're seeing the ripple-on effect in the FX sphere this morning. We saw the Hang Seng, Shanghai index were down. The Nikkei was up, but we saw some risk-off sentiment coming into the markets. And in the European session, we can see that that's that sea of red across the European indices, reflecting that risk-off sentiment. UK FTSE 100 down, Euro stocks down, French 40 down, German DAX down, Portuguese IBEX, Spanish IBEX really down. Italian FTSE. So again, when you get an equity market falling by 1%, then that's really when you want to take notice. So we're seeing some move in the equity sphere. We're seeing some risk-off attitudes, and the major impact was the oil markets, as you'd expect, with the lack of demand expected to come from the oil fields being out of action. US oil made their largest gain in history at the reopen of trade on Sunday after 5% of the world's oil supply was taken. I think US crude jumped by 15% and UK Brent jumped by 20% on the open. So some really significant moves that were coming in there. The currencies that obviously gain on oil spike is the Canadian dollar and the Norwegian krona. Remember, as of course, the Canadian dollar has a very high, the Canadian economy has a very strong oil export economy. So oil prices affect a Canadian dollar. So obviously with the spike in oil's price, then that's a boost for the Canadian economy. So we'll see the Canadian dollar being supported at the moment. And the Norwegian krona as well, again, is a large export oil economy. So when you have a spike, a gain in oil price, that benefits the Norwegian krona. And remember that the Canadian dollar, the US dollar Canadian dollar currency pair has around a 96% correlation with oil. So literally when oil is up, you see US dollar Canadian dollar pair down. And when oil is down, you see US dollar Canadian dollar pair up. So let's just take a look at the US dollar Canadian dollar pair chart just quickly. Okay, I was looking So let's just see. So you can see here that large gap down on the open with oil prices appreciating, and then you see this movement back into the gap and prices selling off, which is pretty much what you'd expect from that kind of scenario. I'm just going to move this just to show the correlation between the Canadian dollar and oil prices. Looking at US oil, so this is one chart that I'm looking at in particular. You can see that we had this very large spike, from the open of 55 going above 63. So that's like an $8 increase. You can see that the price was bid very quickly on the open, and that was initial trade that many traders were taking. As soon as they heard that news, market open, they bought oil, and there was, from the open, there was $1, $2, $3 of upside on oil, taking profit at that big 63 number. And now what I'm expecting, I would expect buyers to re-enter the market around here. This is what I was looking for this morning. I was expecting buyers in this area. We since have had a retrace back down to that area. And potentially from buyers from here, we'll be looking to take profit back up here in the shoulder area. So 61.50 would seem, somewhere between 61 and 61.50 would seem a logical place for buyers to be taking profit. And I would feel confident to keep that buy order in if it wasn't triggered for the next kind of the next sort of 16 hours or so. When you have sort of breaking news like this, you either take the spike, that's kind of the opportunity number one, and opportunity number two is you get the retrace and you trade back up to the highs. Okay, so that's the where I'm expecting buyers from this level, 58.64. Then after about 24 hours, then that sentiment has kind of faded from the market. But that's roughly what I was looking at this morning when I posted this on the Telegram channel or my LinkedIn account, one of the two. But you can see from the screenshot that I did this before. Oil prices have moved a little bit from there. So that's just one chart that's very interesting. Expecting buyers on oil. Again, this is the intermarket correlation cheat sheet. I keep it up here. It's helpful for you guys. If you haven't seen it before, just take a screenshot. Helps you to know what kind of market characteristics you see on risk on and risk off moods. Again, I'm expecting gold to be bid as well with the safe haven play. The concern is that with the unsettled nature between Iran and Saudi Arabia, President Trump has said that he's locked and loaded, ready for action in the Middle East. Russia have said that any retaliation against Iran would be, there's no excuse for it. So there's a lot of big players on the geopolitical scale. So this has lent towards safe haven plays. Gold is obviously a safe havens play. You can see that gold gapped up at the open from around 1488, just slightly above 1488, gapping up to 1512. So it's a large gap. And again, I'm expecting buyers on pullbacks with gold, stops above, and then expecting buyers to be taking profits once again up at those highs, 1508 region. So that's potentially what I'm looking at in relation to gold. So as I said, there's quite a lot that's suddenly taken place, and we're seeing this sentiment shift as it takes place. So now let's get into the week ahead, because we have quite a few different events happening in the week. So today we've got a bank holiday in Japan. We have got a quite slow data points out for Monday. We had industrial production, which was down for China. Again, that's getting a little bit hidden with all the concern about the Saudi Arabian oil field. But that's a concern that if industrial production is falling, that the US-China trade war is starting to flow over into Chinese industrial production, and the concern is once it hits industrial production, it then flows through and hits the consumer and sort of disperses through the rest of the economy. So that's concern. Again, retail sales down as well. That's concern, and that's viewed in that light, like if the global concern is pushing over into retail sales as well. But there hasn't been much reports on that, but it's just something to be aware of. That's a big narrative that is narrative, particularly on trade and how it's impacting US and China, is a constant narrative in the market. Okay, yes, Nguyen. Yes, basically, what Nguyen's asked, about is it wise to delete any shorts in gold? At the moment, with the market being in a risk-off situation, it doesn't make sense to be short gold because we know that gold is a safe haven play. So you can see that we're expecting buyers on dips, and we can see we've already had this dip down to the 50% retracement from the initial move up. So I would expect these buyers on dips for gold to maintain. Now, Nguyen, what you have to realize with FX trading and trading generally is market situation can change. So if it starts to look like, okay, then there's going to be no retaliation, everything's going to carry on to normal, the oil fields are going to start returning back to normal operation, then you might see gold continuing to fall down, and then the gold chart will be focusing on the Fed meeting on Thursday. So that will become the focus. So for me, for right now, for the next kind of like 12 hours, I'm expecting buyers on dips with gold. And then obviously that's an evolving situation you have to be aware of. But I'm not expecting sellers on gold with so much risk aversion in the market. Then risk aversion play. You're going to see risk aversion plays. So you're going to see gold bid, Japanese yen bid, things like that. Yeah, when market is risk off, the yen, Kerrick, the yen is bid. Okay, so we are seeing some bids into the yen. We'll look at the US dollar Japanese yen pair a little bit because we've got slight skewing of the pitch with the Bank of Japan meeting this week as well. We'll talk about that. And Kerrick, tomorrow on workshop we have a section where we look at any trades that people have got. So I'll try to remember whether you can make it tomorrow or not, Kerrick, or not. I'll try to remember this question if we don't get time to cover it today because it's a shorter session today, and we'll try and cover it on Tuesday, and then you can look at the recording, okay, if you don't get it now. Okay, so going on to Tuesday with the FX week ahead, we got the Australian dollar monetary policy meeting minutes. Now, there's nothing particularly expected to be a surprise there, but what I wanted to point out is on Thursday, out from the Australia, we have employment data, and what we've been seeing is that the Reserve Bank of Australia does have a emphasis on employment data. So the employment data will be important for the RBA and will be giving them an indication of, will be whether they'll be more likely to be cutting rates or keeping rates neutral. The thing to be aware of, with the RBA, let me just see. Right, they have got their cash rate at 1%, and they're expected to keep that forward guidance that the board's going to continue to monitor developments, including the labour market, etc., etc. So if the monthly employment change rises, then that means the Australian government, the Australian bank, rather, the RBA, is less likely to be cutting interest rates. So have a look at the monetary policy meetings, but the main focus is going to be that employment data. And obviously, if we see some bad employment data, again, employment changes down, and you see full-time jobs going down, unemployment rate going up, then the market's going to start pricing in a interest rate cut for the RBA. So that's definitely one to keep your eye on. To keep an eye on Tuesday, but again, the main event is the Thursday event. On Wednesday, we've got CPI inflation data out of the UK. Again, the Great British Pound is being consumed by all things Brexit at the moment. So I'm not expecting to see a huge, impact here. So with the pound, we want to look at is how close is Boris Johnson to either getting a deal or not getting a deal. If it's going badly for Boris Johnson and it looks like Britain's going to be leaving without a deal, then the pound will be sold. If it looks like Britain will be leaving with a deal, or Boris Johnson is going to be prevented from making Britain leave without a deal, then the pound's going to be bid. So that's the key way to trade the pound at the moment, is which of those two narratives is winning, and that's what market participants are focusing on, rather than the individual economic data. So don't expect huge moves from the CPI data on Wednesday. And Wednesday evening we have the FOMC. We've got the Canadian CPI data. That's going to be interesting. Now, the Bank of Canada is the only central bank, major world central bank, that has maintained a kind of neutral to hawkish bias. Okay, they're not joining the doves. They're not cutting like the ECB. They haven't got the same problems obviously the Bank of England's got. The RBA have cut interest rates. The RBNZ has cut interest rates. The Federal Reserve has cut interest rates. The Bank of Japan might be discussing further interest rates cuts. Swiss National Bank obviously have negative interest rates. There's a whole swathe of world central banks that have turned dovish, apart from the Bank of Canada. So the Bank of Canada is holding, strong. Now, at the last rate meeting, the Bank of Canada didn't join the dovish central banks, which they were expected to. So that supported CAD. We've also seen CAD supported with oil prices spiking today. So the thing for Wednesday is does the CPI data confirm this strong CAD position? If you get a strong CPI reading, then and oil prices are still being supported, then I expect to see CAD bid, and I would expect to see buyers on pullbacks after a good result. That's what I'd be anticipating. However, remember, the market wants the Bank of Canada to turn dovish. Their core CPI has been good. Their inflation data's in their target band, 2.1%. That's pretty good. Now, if we see a drop in the CPI and that falls down and it's a poor reading, then I'd expect to see some quite heavy Canadian dollar selling, because the expectation will be that the Bank of Canada is going to join the world's other dovish central banks, which is kind of what the market is expecting, stroke kind of wanting it to happen, if almost. Like, come on, why aren't you going in line with all the other world central banks? So that's the narrative. So you've got to focus that into the narrative that's going on. But also, whenever you're trading Canadian dollar, always remember the oil prices, because oil prices impact the Canadian dollar. So you've got to factor that in to the mix as well. Obviously, particularly with oil prices, the largest ever gain, in a single day. So that's having an impact on Canadian dollar as well. You've got to factor both of those in if you're looking at trading the Canadian dollar this week. FOMC is arguably the main scheduled event for the week. The market is expecting the Federal Reserve to cut interest rates by 0.25%, 25 basis points, and that is widely expected. So that's not a surprise. That's what the market's been expecting. So remember, an interest rate cut, it's not as simple as currency is going to go down. Yes, but the market's been expecting this for weeks and months now. So this is not a surprise. So going into the event, which is the statement and the decision, we want to look. This is what we want to look at. So the Fed is expected to cut interest rates by 25 basis points. Alterations to that outlook provide opportunities. So in other words, if we see no rate cut, that would be a big surprise, and we'd immediately see some US dollar strength. So if it comes to Wednesday and you're there and you see there's no rate cut, interest rates aren't cut, they remain the same, then we're going to see instant US dollar strength, okay? And you'd see the US dollar being bought. If we saw a 25 basis point rate cut, but the dot plot shows no more cuts expected, we might see mild US dollar strength, okay? Because a lot of talk has been that there'll be a 50 basis points rate cut, but in the last kind of blackout period, Jay Powell said to the market, you know, he had opportunity to kind of indicate that 50 basis points was on the cards. He didn't. He's kind of really, you know, made it quite clear, really, that it's a 25 basis rate cut. So that's what the market's expecting. So any deviation from that, like no rate cut, would obviously see the most amount of US dollar strength. The rate cut, but dot plot shows no more cuts expected, then mild US dollar strength. And if we saw a 50 basis points rate cut, so that's half a percentage, we would see US dollar weakness, because that will be the surprise. So remember, when you're trading these high top tier events, you've got to understand what's the base level, what's the market expecting, what's the base case. And the base case is a 25 basis point rate cut. So the extent to which we deviate from that base case will affect the currencies. Now, in terms of trading that decision, what traders will be looking at, they'll be looking at risk carefully. We've got to factor risk in at the moment because it's fluctuating. We had a risk on all of last week, we had risk on, and now we're moving to risk off. So look at risk prior to the meeting. So if the Federal Reserve is hawkish, say we don't get any rate cuts, then we're going to get US dollar strength. Okay. If the markets return to risk on, then dollar yen longs should be the strongest. They should be the strongest bids. Okay. If risk is off, then I think New Zealand US dollar shorts should be sold off pretty heavily, because the New Zealand dollar, although it's a commodity currency and it tends to, it's a commodity currency. So when risk is off, you're going to see the New Zealand dollar weaken. Okay, so you're going to see weak New Zealand dollar, strong US dollar if we get no rate cuts. So you'll see strong New Zealand US dollar selling. Now, this is only if there's no rate cuts. Okay, but remember, we are expecting rate cuts at the moment. If the Fed is bearish and it's a 50 basis points rate cut, then we'll expect strong US dollar weakness. So if risk is on, then Australian dollar, US dollar long should be the strongest. Okay, because the Australian dollar is one of the high beta currencies and it's bid on a risk on environment. If risk is off, then dollar yen should sell off pretty heavily. Okay, because you've got the strong yen, weak US dollar. You'd see US dollar, Japanese yen find sellers enter, harden immediately. But this is if there's a 50 basis points rate cut. So they're the two kind of, you know, most unexpected outcomes. So you can get ready. So if they do happen, you know what you're doing, okay, and you know what's going on. All right. We've got the Bank of Japan policy meeting this week as well. Now that is taking place around Thursday morning GMT time. The monetary policy statement sort of comes around, you know, 3:30, 4:30, 5:30 GMT time. That's when you can roughly expect it. And there is increasing, there's increasing kind of speculation that the Bank of Japan might adjust their policy rate. So either that they'll add to QE or they'll adjust their policy rate. Now, if they add to their quantitative easing program, then that whenever a country adds quantitative easing or easy money, asset purchases, all the same thing, that weakens a country's currency. So if that does happen, then we'll expect the yen to be weaker. And again, obviously, if they cut their interest rates, we'd expect yen to be weaker as well. So that's one to watch, okay? Definitely one to watch. Could expect a surprise coming out of that meeting. Then we've got an SMB monetary policy assessment. I'm not expecting that. I have read some analysts, I think it was Nomura who wrote a article for their clients, and I think they see a 0.10% basis point cut following the ECB rate cut last week. So that's just something to be aware of, although, you know, things are holding up pretty strongly for the Swiss National Bank. But that was the only thing that got my attention. I thought, yeah, that could make sense. I could see the SNB following the ECB, because remember the SNB don't want their Swiss franc to get too strong, and they don't want to have the euro fall further against the Swiss franc, so they might try to prop that up by, you know, cutting their own interest rate a bit further, just to get a bit further away from the ECB. Again, something to be aware of. Pound retail sales, again, not expecting anything from that. That's the kind of impact you get. You get you might get a quick spike on the news, and then the sentiment will carry on with the overriding picture, and that just happens to be whatever Brexit is at that time, and whatever particular mood it is. Rate statement for the Bank of England, again, not expecting anything there, because Brexit concerns simply are, you know, clouding out that the normal monetary policy decisions and economic data. It's all geopolitical concerns just surrounding the pound at the moment. And then core retail sales out for Canada, again, it's the same situation that occurs for the Canadian dollar, as we've already mentioned. And again, on top of all of this, you've got to remember this geopolitical concerns with the terrorist attack in the oil fields in Saudi Arabia. And the key thing is, how long will it take to get the oil fields back running? The longer it takes, then the more likely you're going to see oil prices bid. And there is an incentive for the Saudi government to take their time, because Saudi Arabia, they need oil prices higher than they are currently to support their own economy and their own government spending. So, you know, there's an incentive for them to kind of, you know, not, you know, there's an incentive for them to kind of, you know, make it out as, you know, it's going to take longer than it is. So if they took their time over the repairs, that's good, because it's going to make the oil market bid. So that's not an accusation. I'm not accusing anything. It's just, you know, it's just normal human nature. That's, you know, potentially there are some good things for the price of oil from a bad situation from their perspective. So that's just something that, you know, to be aware of, that's going in the background. Again, US-China trade war. President Trump can say anything at any time. You know, he can send a tweet out that sends the market into risk on or risk off mode. So on top of the scheduled events, they're just a couple of geopolitical concerns that we haven't mentioned. We've obviously mentioned Brexit, but there's US-China trade war and the oil situation, and you know, there's obviously North Korea as well. So you've got to remember that those kind of situations can enter in the market and affect risk. Okay, Kerry, we've just got time for your question here. So, where's the go to? Let me just have a look. Just going to pull up US dollar Japanese yen. So Carrick is taking a trade on the US dollar Japanese yen due to the safe haven play. Okay. Yeah, so you're looking at yen strength. Okay, and levels of 61.8 on the 1 hour. So yeah. Yeah, that would make sense to me, Carrick. That would, you know, a short from here, 107, just underneath the 108 level. Stops above recent highs and playing down to these lows, you know, 107.50, 107.6, somewhere between 107.63, 107.60. That would make sense. So a play from about 50-point play. Carrick, that I would have no issues with that. That would make sense to me. Ahmed, okay, Ibrahim. Ahmed's asked, is it advisable to be bullish on the euro US dollar? Now, this is slightly tricky because we've got this descending trend line, price descent. So this is a key part Ahmed, what happens here. Now, the slight complication here, Ahmed, is if you'd said this and what we hadn't had the geopolitical concerns, I would have said, yes, that makes sense to me. Why it doesn't make sense to me now is that the US dollar does act as a safe haven currency. So right now we're starting to see some US dollar strength as a safe haven. You can see it's quite strong selling, okay? So the helpful thing for you is look at this level here. You know, look at this descending trend line, okay? You know, I wouldn't be buying euro US dollar today because of the potential for US dollar to act as a safe haven currency. Okay, so that's my concern with it. All right, you got this trend line here. Get below and stay below, that becomes risk for shorts. Get above, stay above, that becomes risk for longs. So you're at a turning point here. Okay, technical turning point. Personally, I wouldn't be euro US dollar long because my concern would be that the US dollar is going to be bid, which is euro US dollar downside. So Ahmed, that's my concern for that. Oh, Syed, yeah, I'll check with, no problem. I'll look at that. We'll look at that. Yeah, Kerrick, trend lines. We can look at trend lines one day. Sure, no problem. Now, the trade, I'll show you the trade that I was looking at this morning. To the reason, this is my reason for it. Right, so here we had, this was the pound Canadian dollar. There was more talk from Boris Johnson. He was saying, oh, you know, we're definitely leaving the EU on the 31st of October. He's meeting EU's Juncker today. So he was quite, you know, quite bullish on that. And we got Canadian dollar is being bid because, you know, the oil prices. So all of a sudden we saw this gap down here, more negative sentiment for the pound, positive for the Canadian dollar. So the strong currency is the Canadian dollar. The weak one was the pound on fears that Boris Johnson is going to bring a no-deal Brexit. So what I was looking at this morning was looking for a retracement to that 50% level, looking for a retracement there, then back down to these lows. So looking at 3.7, looking at about 30, 40 points on the pound CAD. That was what I was looking at this morning. Okay, guys, really good to have your interaction. Don't forget we've got tomorrow, and tomorrow there is more chance for interaction, and I'm very happy to do that. You see, ask questions, and we've got a new section when we look at any trades that you're looking at. So I kind of started that a little bit today, but if you come in tomorrow, don't forget 1 o'clock to 2 o'clock. You get the free weekly workshops, and I'll go through some of the trades you're looking at. We'll have a bit more time to do it. Don't forget the offers that HYCM do here with 1 hour one-on-one coaching. And Syed, yeah, you're right about the. It is a good topic, that fresh sentiment. I'll check with the support, and hopefully that will be uploaded. Okay, guys, you have a good week. I'll see some of you tomorrow, and thanks for listening. Take care now, guys. Goodbye.